Hello and welcome to CMC Markets and this quick look at the week ahead starting the 29th of May and coming off the back of another week of record highs for the FTSE 100 and the S&P and another week of pretty much trading sideways for European equities. What we've also seen is this further gains for the euro against the dollar. A large part of that I think is down to the fact that we've seen significant improvement in European economic data. And I think that's raising expectations that the ECB may well start to have to consider some form of tapering program before the end of this year. And that's borne out by this particular chart here, which has shown that yield differentials between US 10-year yields and German 10-year yields have come in quite considerably since the beginning of the year. And we can see that if we also look at euro-dollar was around its lows around the end of December, and it's now around its highest levels as these yield differentials come in. And I think the key question now, as we look ahead to the new week, in a week where we've got an awful lot of data, not only US but also European, is to whether or not, first and foremost, the data that we get out of the US makes it more likely that we get a US rate rise in June, which the market is still currently pricing at an almost 85-90% probability, depending on where you look. But also whether or not the ECB will feel compelled to adopt a slightly tighter tone when it comes to its rhetoric and its view of the European economy. Now, Draghi's comments thus far have suggested that he still thinks that economic risks are tilted to the downside, and ultimately what Fed policymakers said in last week's minutes was that there was broad agreement that it would be prudent to wait for further data to establish the fact that the Q1 slowdown was transitory before hiking again. Well, from the data that we've seen since the beginning of May, that would appear to suggest that it's not, I don't think anyway, that it's a done deal that the Fed is going to go in June. Now, there was further details in those minutes about the prospect of the Fed looking to pare down its balance sheet, and I think there is likely to remain an awful lot of debate in the coming months as to whether or not the Fed is going to hike rates as well as reduce its balance sheet at the same time. So when we look ahead to this week, we've got a host of economic data coming out, particularly in terms of the US. We've got payrolls data, we've got ISM manufacturing, we've got ISM services, and we've got ADP payrolls. Now, the expectations around those numbers are likely to come in broadly between 175 and 200,000 for ADP and non-farms. Unemployment rate is likely to remain at 4.4%. But the data item that I'm paying particular attention to is not really the non-farm payrolls number. It's the core PCE number. And that is due out on Wednesday, the 31st of March, because I think some Fed policymakers have suggested that they are concerned about a slowdown in core inflation. And that is really being borne out by this particular chart here. This is the Fed's preferred measure for measuring inflationary pressure. It strips out all of those volatile items like fuel and energy and what have you. And as we can see from this number here, 1.6%, we've seen a sharp drop back between February and March. Now, we get the latest number for April next week, and that's expected to show a further decline. So the big question I would be asking as we head towards that June 14th Fed meeting is, if we get a further decline in this particular index here, does it make it more or less likely that the Fed is going to move in June? And I would argue potentially that it's probably going to make it less likely, despite the fact that all the pointers in the markets would appear to suggest the Fed is definitely going to go. Certainly the foreign exchange market doesn't appear to be buying the fact that the Fed is going to go in June, and the bond market doesn't appear to buy the fact that the Fed is going to go in June, simply because when you actually look at the yields here, and you look at US yields, 224.31, they're still just off the lows that we've seen in April. So this 216 area, 217 area for US 10-year bond yields remains a very, very key support area in the short to medium term. So we're going to be keeping an eye out for that. We've also got EU CPI data for May. And again, that's likely to come in around about 2%, the 2% level. Core CPI around about 1.2%. Those showed really big jumps in their most recent numbers. Core CPI in particular jumped from 0.7 to 1.2. So the big question is, will that be sustained, or will that actually gain further traction? I mean, a lot of the gains that we've seen over the course of the past couple of months has been a result, certainly in terms of the rise in oil prices. But looking at this euro-dollar chart here, we can see that here we've got a potential bearish reversal, but it does look as if that's probably going to get negated. But even if we do move above the highs that we've seen so far this month, around about 112.70, we've still got huge areas of resistance all the way up through to 113 and 114. So big areas of resistance to get through in the short to medium term for euro dollar. So I think that's a really, really key area for me. I think we're starting to get a little bit overstretched given the gains that we've seen since the beginning of April. We've come from 106 to almost 113. You have to question whether or not the ECB is going to be happy with that type of move higher. The last thing they really want at the moment is a higher euro. We've also got manufacturing and construction PMI out of the UK. Once again, that 130 level in the cable is proving to be a very tough nut to crack. The pound has declined substantially also against the euro in recent weeks, and last week's GDP numbers, the Q1 GDP numbers, were weaker than expected, which does undermine a little bit the stronger sterling scenario. But to caveat that and put that into some context, the last 2 years Q1 GDP numbers have also been weak. In Q1 2015 they were 0.3%. In Q1 of 2016 the GDP numbers were 0.2%, and again we've seen a 0.2% read here. So keep an eye out for the manufacturing and construction PMIs. Manufacturing was particularly strong in April. Expect that to be a similar case in May as well. So to round off, next week we've got our non-farm payrolls webinar at 1:15 on Friday with me and Colin Szynski. Tune in for that. You can sign up for that on the Learn section of the website under webinar and events. Otherwise, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.